Is this Asia outperformance call based on the COVID recovery that we're seeing? And how does that start and stop of the reopening that Heidi mentioned earlier really threaten this recovery?
Yes, I think that we're certainly, we've seen the worst of the Omicron spread in Asia and particularly in China. And I think that we're certainly not out of the Omicron woods yet, but I think that the worst is behind us. And I think that there should be a bit of a reopening boom, both for consumption and also for tourist spending around the region.
David, that worst is over call also for Chinese equities. We are now seeing, as this chart on the Bloomberg shows, major indices trading above their 50-day moving average. But what happens with that regulatory crackdown, not to mention, of course, the renewed restrictions from COVID?
Sure. I think that we have certainly touched at the bottom, I think, of Chinese equities. I don't think that we'll get back there. It doesn't mean that we're not going to see any kind of near-term volatility in Chinese equities, which I think we will, given Fed aggressive tightening coming up and still some COVID remnants of potential lockdowns in other cities. But I think that the recent outperformance for Chinese equities, I think that has a bit of legs left to run still. But you're right. I think that there are still a few impediments and a few headwinds that investors have to take into consideration.
You're looking to overweight low volatility opportunities within equities. Where do you find that in this environment?
I think it's a very challenging environment right now, given a lot of the uncertainty of Fed tightening and how quickly and and what velocity they're going to tighten. And I think that this is a period of consolidation as investors try to assess a lot of these different factors. And we're certainly still in a risk-off mode as investors try to assess these variables. But I think that from now until the end of the year, we will get back to risk-on mode. And in that situation, I think that places like Asia and other emerging markets could benefit.
You talk about transparency when it comes to earnings as being key at this point. Given that we're in this kind of liquidation type mood, right? Does that mean the bar when it comes to the next few earnings seasons are going to be that much higher?
I think so. I think that we're certainly in an environment where investors are looking at companies that have strong balance sheets and good cash flow and earnings growth. And I think that kind of pivot will certainly remain for the rest of this year. I think that the era of ultra loose accommodative policies that lifted all boats, I think that has passed, and investors are going to become a lot more discerning.
When you say about that kind of dispersion between bonds, credit, equities, what are you looking for in terms of the fixed income space at the moment? I know the preference is still to overweight equities in this environment.
We have a slight preference of equities over fixed income. And given some of the massive bond movements that we've seen so far over the past couple of days, I think the US 2-year has basically priced in aggressive Fed tightening. Perhaps the 10-year could float up a little more from here right now. But I think that investors should take a very close eye on where they want to be positioned in fixed income. And I think that I would still prefer a bit of duration over credit, given the current dynamics.